Dear clients, welcome to PhillipCapital's Weekly Market Watch. I'm Benjamin, Analyst from Phillip Securities Research. Today, I will share with you on the earnings results of some of the companies under our coverage. OCBC 3Q14 results were largely in line with our previous expectations when we exclude OCBC Wing Hang's contribution. Loans growth momentum was unchanged from last quarter at 1% Q&Q ex OCBC Wing Hang. With the consolidation of OCBC Wing Hang, the loan book was boosted by 15% Q&Q, with a 91% jump in the Greater China book. OCBC Wing Hang currently accounts for 12% of OCBC's total loans. Net interest margin was down 2 basis points Q&Q, which is no surprise as we had factored in the normalized level previously. Fees and commission ex OCBC Wing Hang, by our estimation, grew more than 10% Q&Q from strong wealth management and loans-related fees. Total core non-interest income was dragged down by Great Eastern Holdings' contribution from lower mark-to-market gains in a non-par fund. A one-off remeasurement gain of 391 mil was recorded as OCBC increased its stake in Bank of Ningbo to 20% and subsequently became an associate. We upgrade our rating to accumulate with a revised target price of $11. Although we still remain cautious on the synergistic values of OCBC Wing Hang and earnings volatility from Great Eastern Holdings, valuations are currently looking undemanding. UOB delivered a solid set of results for 3Q14, reporting a net profit of 866 mil, up 7.2% Q&Q. Net interest margin remains stable at 1.71%, in line with our expectations, proving that concerns over deposit costs spiraling out of control was undue. Fees and commission delivered a superb quarter, growing 15.8% Q&Q, driven by investment-related and loan-related fees. Main surprise this quarter was UOB's net trading income, which rocketed 68% Q&Q from higher treasury customer flows and trading income. Our view on UOB is unchanged. We like their overall resilient earnings profile, strong capital position, and cautious business approach. We upgrade our rating to accumulate with an adjusted target price of $25.40, and we remain confident in their disciplined business approach. DBS delivered a big bag of positives this quarter again. 3Q14 net earnings of 1B was 8.4% higher Q&Q, beating our expectations by about 6%. Key positives for 3Q14 were, number 1, steady loans growth of 2% Q&Q, which was led by corporate and SGD consumer loans. 2, stable net interest margin uptick of 1 basis point to 1.68%, the highest in 9 quarters. 3, strong fee income that grew 10% Q&Q, driven by stable wealth management income and an 81% growth in investment banking fees. Number 4, higher net trading income growth of 54% Q&Q. And lastly, robust asset quality, where NPL ratios remain low at 0.9%. DBS remains our top pick in the banking sector for its robust and disciplined trade finance business, strong deal flow pipeline, diversified franchise, and the best positioning to benefit from an interest rate cycle revival in the medium term. Based on DBS's potential to outperform, we maintain and reiterate our buy rating. We will be sharing some brief highlights on Raffles Medical Group today, which we have initiated coverage last Friday. On Raffles Medical Group, it has recently reported strong 3Q results, underpinned by growth from both hospital and healthcare services segments. Top-line growth contributing factors include additional new specialists, increase in number of total foreign patients, expansion of Raffles Medical Clinic network, growth from its healthcare insurance services, and acquisition of major corporate client accounts. Positive developments to note are Raffles' 2 development projects. 1, the extension of Raffles Hospital, and 2, the new property redevelopment in Holland Village, which are expected to be ready in 2017 and 2016 respectively. The group also intends to build 2 tertiary private hospitals in China, 1 in Shenzhen and 1 in Shanghai as well. While we continue to see growth driven by medical tourism, rising affluence and aging population in Singapore and in Southeast Asia region, shares are trading at forward PE of 30 times and are fairly priced in our view. For more details, kindly refer to our initiation report in Poems. SMRT's quarterly revenue grew 6% year-on-year to 314 million, while PATMI jumped 75% year-on-year to 25 mil. The positive results were mainly due to Fair Business recording a 5.5 million profit compared to 6.8 million loss in the corresponding period last year. SMRT's cash flow remains weak, with operating cash flow unable to support capex requirements. Balance sheet is also highly leveraged with an additional 200 million of debt taken on in October. Hence, 3Q FY15 net gearing expected to rise considerably. 1.5 cents interim dividend was declared, up from 1 cent for the same period last year. OSIM has reported a disappointing set of results on 28 October with net earnings down 28% year-on-year, triggering the share price to drop 20% since then. With a sharp decline of the share price recently, it's an opportunity for investors to revisit the counter. In view of the aggressive TWG expansion and ongoing legal cases, the bottom line margin will face a drag for FY15 and FY14. The uncertainty regarding fund deployment may also continue to weigh on OSIM's share price in the near term. However, the business fundamentals remain intact, with TWG business to be a significant earnings contributor once operating expenses are normalized. We maintain our accumulated rating with a lower target price of $2.69. FNF Ventures Group, also known as FNFV, was spun off with a stated intention to monetize its portfolio of investments consisting of diverse business. In the 4 months since, it has already swapped its Comdata stake for publicly traded FleetCor shares, announced a distribution of Remy International shares to FNFV shareholders, and filed IPO paperwork for J. Alexander's. We believe there's substantial short-term upside based on our sum-of-the-parts analysis, as well as a strong management that continues to execute successfully. With that, I come to the end of the presentation. Thank you for watching this week's Market Watch. I'm Benjamin from Phillip Securities Research. Tune in for more Market Watch videos.